I believe in the 5-year time frame, the 10-year time frame, that gold will do very well even from here. It may be in the very short term overbought. I'm not a technical analyst, but when I look at the chart, it begins to resemble what the Canadians call a hockey stick chart. And I would tell traders that the backside of a hockey stick is just as steep as the front part of the hockey stick, but nowhere near as much fun if you happen to be long. If you don't own gold and you're prepared to own it for 5 years or 10 years, this is a good entry point. If you're a trader or a speculator, if you have trauma holding a position over a long weekend, this is a good time to take your profits and run.
Gold's allure isn't just in its shine, it's in its ability to protect wealth when currencies falter. According to veteran investor Rick Rule, gold remains a compelling long-term investment, even if it appears overbought in the short term. Historical patterns suggest that periods of rapid price increases, often resembling a hockey stick chart, can be thrilling for traders but carry significant downside risk. Investors willing to commit to a 5 to 10-year horizon may find current levels an attractive entry point, as the potential for sustained growth outweighs short-term fluctuations. The performance of gold is closely tied to the erosion of fiat currency purchasing power. With the US dollar expected to lose a significant portion of its value over the next decade, potentially around 75% in real terms, gold offers a safeguard against this decline. While a dramatic 30-fold increase like the 1970s is unlikely, a more modest threefold rise is plausible, reflecting both absolute and relative gains as the dollar weakens. Gold, therefore, acts as a strategic hedge in preserving wealth against inflation and currency depreciation. Portfolio management strategies also play a key role in mitigating risk. By reallocating capital away from company-specific or operational exposure, investors can still capture the broader upside of gold while reducing volatility. Accepting a partial sacrifice in potential gains becomes a trade-off for stability and security, allowing investors to benefit from gold's long-term growth without assuming unnecessary risks. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
I believe in the 5-year time frame, the 10-year time frame, that gold will do very well even from here. It may be in the very short term overbought. I'm not a technical analyst, but when I look at the chart, it begins to resemble what the Canadians call a hockey stick chart. And I would tell traders that the backside of a hockey stick is just as steep as the front part of the hockey stick, but nowhere near as much fun if you happen to be long. If you don't own gold and you're prepared to own it for 5 years or 10 years, this is a good entry point. If you're a trader or a speculator, if you have trauma holding a position over a long weekend, this is a good time to take your profits and run. Perhaps if I might elaborate a little bit about the reasons behind it. My experience, 50 years experience in this market, tells me that the gold price does well when savers or investors are concerned about the deterioration of the purchasing power of their savings in fiat currency denominated issuances. Could be euros, could be dollars, whatever. I believe that the purchasing power of the US dollar, in particular, will decline in absolute terms by 75% over the next 10 years, mirroring the decline that we experienced in the 1970s. The analog is, of course, in the 1970s, the gold price escalated 30-fold. I'm not, by the way, suggesting that gold escalates 30-fold from here. I'm suggesting that the nominal price of gold could well mirror the decline in real purchasing power of the US dollar. Therefore, could a 75% decrease in the absolute purchasing power of the dollar result in a threefold nominal increase in the price of gold? Yes. A further note, I don't think that the US dollar will do poorly against other currencies, although it has done poorly against a basket of currencies this year. While I suggest that the absolute purchasing power of the U.S. dollar will decline, I think that the U.S. dollar will perform at least in line with other currencies. So relatively, the U.S. dollar does okay. Absolutely, the U.S. dollar does poorly. Relatively, gold does well, and absolutely, gold does very well. I actually believe that the specs will outperform the best of the best, but I don't care. I want to de-risk my portfolio. I want to capture the beta, and I want to reduce my alpha exposure. By the way, the other 50% of the money I'm putting into the oil and gas business, which is still hated, and we could talk about later. Now, I was early and I was big, and there are a lot of people who don't have the same gains to protect as I. I'm not suggesting that people in other circumstances should sell. But since you asked me what I did, I decided to tell you. If I do an intrinsic value of these, well, some of these companies are exploration stage. And so I have a target size, and I adjust it to probability. But I also adjust it to what the market is telling me. Right now, the capital formation window is wide open. And literally hundreds of companies are doing financings. One thing a company tells you when they do a financing, if they're trading their paper for your money, is they're telling you that your money is worth more than their paper. Who would know better than them? So if I have the whole market telling me that my money is worth more than their paper, I'm making that trade with some of my money. It has been too easy in the last 6 months. And with the financing window so wide open, I decided to take a little too. Probably a mistake in the long term, but I'm okay with that. And, you know, traditionally in a bull market, the money flows down the market cap and quality trail. So it's likely over 2 years that the juniors I sold will outperform the best of the best that I've bought. But I'm okay with that. If I give up a little bit of my upside in return for de-risking my downside, not taking company risk, not taking operational risk, but capturing the gold beta, that's right exactly where I personally want to be.
Rick Rule highlighted that gold's potential as a hedge is rooted in structural and political realities. A full remonetization of gold is highly unlikely as it restricts political power, a constraint most politicians avoid unless necessary. He explained that decisions to sell gold would depend on major systemic changes, such as balanced budgets, credible debt reduction plans, and positive real interest rates. Until such conditions arise, gold remains a strong store of value, especially when government policies erode the purchasing power of fiat currencies. Rick Rule also emphasized that investors must be aware of gold's inherent volatility and cyclical nature. Historical examples, like the 1970s bull market when gold surged from $35 to $850 but experienced a 50% drop mid-cycle, show that long-term gains are rarely smooth. Short-term fluctuations of 10 to 15% over a few months are common, and larger cyclical swings can occur. Understanding these dynamics allows investors to use gold strategically as protection against currency depreciation while staying prepared for periods of significant volatility. Let's get back to the interview.
I don't think that, save a real crisis, there'll be a remonetization of gold, Stein. Imagine yourself as a politician. Imagine the real risk that you put your family at being a politician. You do that because you love power. Gold restricts politicians' power. A remonetization, unless they had no second choice, I don't think has a hope in hell of occurring in any political jurisdiction in the world. Where does this end? I like to answer the question by telling you what would cause me to sell my gold. That's where the market would end for me. If in the United States and other, in particular, Western nations, if we had a viable plan to service our debt and reduce it, if we had balanced government budgets, if in the United States we had a political accord that allowed us to reduce the net present value of off-balance sheet liabilities. And in particular, if we had positive real interest rates. Let me explain the last one. If you are a U.S. investor and you believe the government statistics around inflation, they suggest via the CPI that the deterioration of the purchasing power of your dollar against their basket of goods and services is 2.9% a year. Anybody who looks at the price of the basket of goods and services that they consume, not the government, will tell you that at least since 2020, the deterioration of the purchasing power of the US dollar has been much closer to 8. Now, if you're a saver in US dollars and you buy the so-called benchmark savings product in the world, the US 10-year Treasury, you're getting paid 4.6 in a currency that's depreciating at 8% a year. In other words, you're not making 4.6, you're losing 3.9. What could make you more concerned about the deterioration of the purchasing power of your savings than a guarantee that you lose almost 4% a year compounded for 10 years? In other words, if you give the U.S. government your money in a U.S. 10-year Treasury for 10 years, they guarantee to give you back at least 40% less than you gave them. That would concern me. The consequence of that is that I think gold will do well. Now, people need to understand that gold will be volatile and it will be cyclical. In the 1970s bull market, the gold price went from $35 to $850. Hell of a run. In the middle of that run, in 1975, the gold price fell by 50%, 50. And I'll tell you, that had a real psychological impact on some of the people who thought they were faithful. So people who buy my gold thesis, people who hear me say that its rise will mirror the deterioration of the value of the U.S. dollar, need to understand it's not going to be stair steps to heaven. There's going to be volatility, which suggests 10 or 15% fluctuations in a 3 or 4 month period. And there's going to be cyclicality, which suggests greater deterioration in price. Forewarned is forearmed. There's a case that can be made for that. The U.S. On-balance sheet debt relative to GDP is higher. The U.S. economy, however, is more productive now. It is a capital-light economy. The U.S., for all its faults, is still a place where a bunch of folks your age can commandeer a garage in Sunnyvale, California, and out pops Google. We have been able for 40 years to have our individual initiative and work fund our collective stupidity. The problem with that thesis now is the off-balance sheet liabilities of the U.S. government: Medicare, Medicaid, Social Security, federal pensions, military pensions. Many people don't know this, Stein, but the net present value of off-balance sheet liabilities at the federal level, according to the Congressional Budget Office, exceeds $120 trillion.
Gold remains a highly compelling long-term hedge against the erosion of fiat currency purchasing power, especially in an environment marked by high government debt and substantial off-balance sheet liabilities. The combination of structural fiscal imbalances, negative real interest rates, and guaranteed losses for savers creates a strong case for gold as a store of value. While short-term volatility and cyclical swings are inevitable, these fluctuations are outweighed by the metal's potential to deliver strong real returns over a multi-year horizon, particularly for investors seeking protection against systemic financial risks. For those willing to hold positions over the long term, gold provides a way to capture broad market upside while simultaneously reducing exposure to company-specific and operational risks. Its role as a portfolio stabilizer becomes even more pronounced in periods of economic uncertainty or currency depreciation. By incorporating gold strategically, investors can preserve wealth, protect purchasing power, and maintain a balanced approach to long-term financial security, making it an essential component of prudent portfolio management. How can investors balance gold's long-term hedge potential with its short-term volatility in a diversified portfolio? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support and we hope you enjoy the video.